Hi, I'm Steve Van Metre. Welcome to your weekly economic update where we take about 30 minutes every Friday to take a deeper dive into the economic data or just whatever on my mind. So today I've got two special things for you. One, we're going to identify or try to identify the price of crude oil that, if broken below, will send prices plunging. I know, it sounds hard to believe, but we're going to try to do that. And then I'm going to try to make sense of what's going on in gold, because what we're seeing in gold is not the real move. I can prove it to you up until the point where things get a little murky and I don't have a complete explanation for you. I'm trying to figure it out. I don't think anyone has an answer to it because I don't think anyone's seen this correlation. And I've seen a ton of videos on gold bulls this week about how prices are just going to go straight up. But they don't have the gold playbook. We do. So we'll take a look at that, and then we'll see if we can answer that question on crude oil. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, our own personal capacity. Opinions expressed in this video that I'm own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So while we're on the subject of the charts, let me switch over and let's just go through them and kind of get them out of the way, so we can, because once I get on the gold thing, we're gonna be there for a little while, and I don't want to lose focus. So the growth rate of the money supply, and I will show you why when I get into the gold story of why this is rising. I've got the charts from the Federal Reserve for you. And mainly it's because the U.S. Treasury is emptying their accounts. It's not because of any other reason. I said I was wrong, so I will admit that very willingly here. So we see the money supply is rising, but all of a sudden the 12-month, 6-month, and 3-month rate of change all started to flatten out. I mean, it rose, but we're talking like 4.8 something to 4.97. Not a big jump. These flattened out. I'll show you what's going on. But for the moment, I suspect this should be flat or maybe even slightly turned down going into the end of the month. I'll show you why in a little bit. Commercial industrial lending, growth rates down to 6.15 from 6.7% a year ago. I am going to show you the data on that. You're going to get just a brief window of my editing software, but here is commercial industrial lending. Here's the 12-month rate of change at 6.15. Here's the 6-month rate of change at 1.65. So doubling that, you get a little over about 3.25%, 3.3%. So the 6-month rate of change is saying this 12-month is coming way, way down. And here you have the 3-month rate of change, which is saying that the 6-month rate of change is a little too high because this is at 2.8% annualized. And you can see there's a lot of weakness in this 3-month rate of change. All that means is the economy is not creating a lot of new loans, very few, and we're in a debt-based economy, so you need to see a lot of lending. Well, who's the biggest lenders? That would be your commercial and industrial banks. So we're not seeing a lot of lending growth there, and every time we've seen this contract, and it didn't contract in 2016, but it almost did, you have a recession or you're in a recession. So this blue line should fall quite a bit in the weeks that come. At least that's what we should expect. As far as consumers go, they had a little bit of an increase on their credit card spending to 4.15, but overall the trend is still slowing down as consumers look like they're retrenching. And the Federal Reserve dropped their balance sheet $7 billion last week. It looks like they got rid of some more of their bonds, and they're, from what we can tell, they're focusing still on the long end of the curve. I mean, they're trying to dump their long-term treasuries for short-term treasuries, which is great news for anybody who owns long-term bonds, because when the Fed sells long-term bonds, interest rates go down. So that's good news. This will be wrapped up, let's see, into September will be the end of their balance sheet unwind. And bank deposit growth started to turn up last week, took a little hold here, but this will be very interesting if this starts to accelerate, because what it's telling us is consumers are starting to put money in the bank and stop spending. That would be very, very interesting. So looking at some of the other charts I've got this week for you, the ISM manufacturing headline is closely correlated with yields. I think I've probably said something like that, but I do not have access to the ISM manufacturing data feed. It used to be available on the Federal Reserve website, and they took it down some time ago, so I don't have access to it. But you can generally see as yields go, so does the manufacturing sector. And that makes perfect sense when you understand that we're in a debt-based monetary system, and when interest rates are rising, it's because money's flowing into the economy. And when interest rates are falling, it's an indication of tight financial conditions. So when yields break their major support level and go down, so will the factory data and so will the stock market. There's been a lot of talk this last week about how rate cuts are bullish for stocks. They aren't, but look, when you're in a bull market, everybody needs any excuse to buy stocks for any reason, no matter what it is, even if it's not true. And I don't know, Crescent Capital put this together, and they said, look, here's the first rate cut, stocks go down. First rate cut, stocks are peaking, then go down. And then, well, we haven't gotten our first rate cut, but in theory, that may come at the end of this month. I'm not 100% that they're going to do it, but it certainly tells you that by the time the Fed starts to cut, the party is already over. Now, the retail sales data looked very good this month, or last month actually, because it's always a month behind. But the Red Book retail sales isn't showing the euphoria of the government data. Well, that's because the government data seasonally adjusted theirs to make it look good. The government's doing everything possible to make everyone feel like the economy is in great shape, including putting some big seasonal adjustments into the retail sales data. Northman Trader put this out on his Twitter feed. It says, look, we're in this broad megaphone style pattern. So you see if someone was speaking into the megaphone. And usually when these patterns happen, eventually it comes back down to the bottom of the megaphone, which would be very interesting because that could take stock prices all the way back to where they were before the presidential election. And last, a lot of people are wondering who's buying stocks. Well, if you're not sure, it's you. And the reason I say that is because it's not foreigners. The aggregate $215 billion in sales in the past 13 months is the largest liquidation of U.S. equities by foreigners on records, courtesy of Zero Hedge. So you've got retail investors buying, hedge funds looking like they're playing chase, and corporations buying their shares back. Everybody else is selling. What does that tell you? Well, if you're playing chase, good luck, because you'll be, sorry about that, last man standing. All right, let's go on to I want to clear off a couple of these tabs, and then I will get into the whole gold thing. It'll just help clear my mind a little bit, if you don't mind. So we'll take a look at the Nasdaq Mcclung Summation Index, and it's not making new highs. It's not even close to its recent highs. And as I said, this is telling us there's something clogged in the pipes, in the plumbing of the market. And when the thing rolls over and heads down, there should be a big plunging in stock prices. So this, as we've seen in the past, this should have been way up here. Should be telling us that, hey, everything's A-okay. And the fact that it's only 100 points over zero is telling us, yeah, something isn't quite right here. Now, I don't have a lot to say on these exact climate charts. We do like to look at them, but I've got a couple points of interest of what's going on in the Midwest. So, and I couldn't find, let's see, heat index. I don't know if that, that's definitely, click on a region to get more. That's not what we want. Anyways, the Midwest is going to see triple digit, or is starting to see triple digit weather. I don't know if it's today, yesterday, but it's happening, and it's expected to go for about a week. Now, this is the 6 to 10 day outlook, so this is saying 6 days from now, or July 19th from today. So the Midwest is going to be hammered with really hot weather. Now, why does that matter? Well, crops do not like overly wet weather, which they've been doused with, to say the least, and they don't like really hot weather either. So when you look, and this is great information that I got from a agricultural meteorologist, I think that's what he was, and he said if the root system is deep enough where it can get to the water and it can keep the plant in good shape, a good crop can handle 4 or 5 days of really hot weather. It doesn't like it, but it can handle it. He said the problem is right now, root levels are really shallow. This Plantings were late, ground's real wet, the conditions were not ideal. He said at best can handle 2 days of 100-degree weather. Two days of weather over 90 degrees, and it's going to hit triple digits all across the Midwest for 4 or 5 days as it's expected to. Could severely damage crops. And what's really interesting to me is we're seeing a food shortage in stores. Nobody's really talking about it. No one's saying why, although we have seen some signs in some stores now that says due to the poor harvest, we're short this, but we expect that to change with the next harvest. Well, the next harvest is about to get obliterated by heat. So I don't know about that. But looking out on the 2-week map, guess what? We've got rain coming back to the Midwest, something they don't need more of, but they might need some of it. But they've got plenty of it as it is and more on its way. And then the last chart we'll look at before we stop and chat about gold, we've got the assets and liabilities of commercial banks. We've got Treasury securities. They dropped about, that's securities. Treasury and agency securities dropped $3 billion, $3 billion in mortgage-backed securities and $1 billion non-mortgage-backed securities. So a total about $7 billion in bonds. And I looked back on the auction data. There wasn't. I'm beginning to think that there's a strong correlation between the week of the Treasury auctions and when the banks are buying. And so I looked back for the week of, July 10th. There wasn't a lot. There was a lot of very short-term, real short-term auctions. Next week, going backwards, there's some longer-term bond auctions. So I'm going to be really curious to see if that's where the banks are buying. We'll see that next week in the data. All right, so let me get that cleared up. All right, so let's talk about what's going on with gold. Now, as I mentioned, I saw several videos this week, several interviews about the bullish case for gold. And believe me, I get the longer-term case for it. I've written about it. I've covered it. I know it's there. I also know I need to buy at a point where I know it's not going down further. And there's a very simple reason. Somebody like, well, why aren't you just buying? Because these stocks can move 10% in a day. And that doesn't just mean up. It also means they can move down 10% in a day. And so when you know they can move that rapidly and you want to take a position, either you better buy low enough where you can absorb a 10% hit after it goes up, or you better be able to get out real fast. And that's hard to do when you're moving a lot of money around. You just can't do it. So we really need to make sure of what we're doing. So I've looked at this big move in gold, and I've addressed my gold playbook, and I've listened to all this bullish stuff that people have to say, and I've got a lot of problems with it because I don't buy them. Now, there is agreement among certain professionals who trade gold that gold follows what's called real yields. Real yields are inflation-adjusted yields. Simply take the 10-year Treasury yield and subtract the year-over-year rate of change of the Consumer Price Index, and you'll get a pretty chart that looks like this. And you can see that here's real yields, and we can back this thing up, and you can see there's a pretty good correlation here. You can see it dipped here, but overall, they kind of followed a similar arc across the board. So overall, this is pretty good. And in the last 10 years, it's really tight. But look what's happening to real yields in red. They're flat. They're absolutely flat. So the question that, when you go to invest, you have to ask a lot of whys. You have to be like a little kid. Why, Dad? Why, Mom? Why? You have to ask why. When someone calls and says, I want to buy this stock, the first question I ask them is, why? Well, I think it's going up. Why? Well, because I just bought a new car, and if I bought one, then other people are buying one, so that stock's going to go up. You got to ask deeper questions than that. You really, really have to. So we do know that gold follows real yields. Now the question is, if gold is rallying, let's go to our playbook and see. Is it because yields are falling and consumer prices are rising? No. Yields are flat right now. So are consumer prices rising? Well, no, they're not. They aren't. In fact, we saw the CPI index go down a little bit, and we're seeing reports out of Asia saying that their producer prices and consumer prices are falling, and their factory utilization is falling. So no, consumer prices, no, that's not it. So let's see. Let's go over here. What do we've got? Yields falling faster than consumer prices. Well, yields are flat, right? At least they've been flat for a couple weeks now. So no, that's not it. How about here? Yields rising and consumer prices rising faster than yields. Well, now we're coming back to, well, we know yields aren't rising and they're not falling. They're neutral at the moment. So are consumer prices rapidly rising? Not based on the recent CPI index. And let's dig deeper, right? Let's ask some deeper questions. Are lumber prices rising? No. Are crude oil prices rising? No. So there's some big, are medical costs rising from when last I saw it? No. So you look at our housing. Well, we know prices are still rising a little bit, but we're seeing sales start to roll over. I guess it'd be this way for you. And we're seeing building permits go down. So it suggested housing isn't. So no, that can't be it. So let's go to the last one, which is a big no. Is yields and CPI falling at this roughly the same rate? Well, yields are flattish and CPI is falling a little bit. So that's the closest narrative to what we've got. And it's saying no gold. No, saying no. Okay. Well, before I show you the next chart, actually, now that I think about it, you ever have one of those moments where you're looking at something and you go like, I've seen this before, and you can't remember where? That's what happened to me with gold. And in fact, it happened with me with crude oil. So I was looking at the gold chart. No, I was looking at the year-over-year rate of change in the M2 money supply. Oh, wait, before I get to that. So we also know that gold follows inflation. I mean, it really likes when inflation takes off. So this is gold against the money multiplier. And the money multiplier is the closest thing to inflation. And you can see gold prices stayed high along with the money multiplier. When the money multiplier crashed, we can go back even probably a little bit further. You can see they kind of stay the same. And then when the money multiplier crashed during the great financial crisis, and why did it crash? Because the Fed did quantitative easing. Now gold is shown inverted. So you see I've got it inverted up here. It doesn't say inverted, but it's inverted. You see gold prices went through the roof. Okay? So now what should happen? Well, gold prices settled down because the money multiplier started rising, and then gold started to rise. This is inverted. So let's see. Gold started to fall a little bit as the money multiplier fell, and as money multiplier started to rise, what happened with gold? It started to fall and bottom out, and now it's starting to rise. But guess what? The money multiplier is still rising. In order for this to be bullish for gold, the money multiplier needs to crash. In order for that to crash, Fed needs to be back at zero. They need to be doing quantitative easing like they've never done before. So that's not it. So that's not why gold is rallying. So now we're on to the next chart that literally put me in my place. And this is where I don't have a lot. I can explain to you what's going on. I just can't tell you why this is happening. And I've not seen anyone else with this correlation. It literally just was looking at the M2 money supply on a year-over-year basis, the blue line. And I thought, God, it looks really like the gold chart. And so I overlaid gold. Now, I'm not cheating. You'll notice this is dollars per troy ounce. I'm not using the year-over-year rate of change of gold. This is purely just gold trading against the year-over-year rate of change of the M2. And you can say, well, but maybe it's had a longer-term correlation. It doesn't. Not correlated at all. None. That's why I've never looked at this, because I've looked at this a long time ago. Well, I shouldn't say never looked at it a long time ago. There's no correlation. And then, boom, you look at it in the 10-year period, you go, whoa. You go to a 5-year period, you're like, that's pretty good. 1-year period, that's pretty good too. So why is this happening? Well, I'll give you my best explanation I can. Again, I cannot explain why the two are tracking. No clue. It does not make any sense. But if it is true over longer term, it does have some implications. So let's identify one. Why is the money multiplier rising? Well, I'll show you why. The U.S. Treasury is currently draining down its supply of cash. So what the government does nowadays is when a budget bill is passed, which one hopefully will be passed in the next 30 to 60 days, the Treasury will go out and borrow an excess of money. So here's a perfect example. You can see an excess of money being borrowed. They put this on deposit with Federal Reserve banks. There's this treasury deposits at Federal Reserve banks. So they grab all this money and they go stuff it in the member banks of the Federal Reserve. This is not counted as part of the M2. So what you see, even though this is cash sitting in bank accounts, it does not count in the M2. But when you pull this money out of the broad money supply, it does factor there. And when you flush it back in, it also counts there. So what's happening is the government's running out of money. No surprise, because we've heard that from Mnuchin. We know the Congress is, going back and forth about that. And here you can see in May to June, the amount we saw roughly $15 billion or $105 billion worth of money get drained out of the Federal Reserve banks to go pay government bills, Social Security, Medicare, military, and all their other stuff. Now, what's going to happen at the end of July? Well, there's probably going to be at least another $115 billion, if not more, which is going to take the current value of 214, and we'll just say down to $100 billion. So here's $100 billion is way down here. That means the Treasury has less than 1 month worth of money going into September before they run out. And Congress doesn't like to let this thing go to zero, so they're going to be under some pressure to pass this. So we're seeing money come out of Treasury, out of the banks, Federal Reserve banks, into the economy. Now, why would that have a view? Why would that be inflationary? Now, under normal conditions, when the M2 is rising, okay, when the broad money supply is rising, which includes bank accounts and cash and brokerage accounts and all that, what does it tell you? It tells you that interest rates have been lowered and there's money flowing out, through the economy, and it's causing the economy to grow. And when that happens, interest rates should rise and you get inflation. Now, you see where we're going with this? The market, okay, thinks there's inflation coming because they're misinterpreting what's going on with the M2. That's what's happening. So you see this rise in the M2 is causing a rise in gold because what's the formula? Let's go back to our gold playbook. Okay, where we got, here, nope, it's this one over here. CPI rising, right, which would normally be what happens when the M2 rises and yields flat or falling. There you go. So the market is totally wrong about this, completely wrong about it. Now, the implications of this are problematic because if this relationship is true, the moment the the Treasury gets the green light to refill their bank accounts, they're going to pull probably, what did this thing peak at? 400 billion. We're going to get down to probably 100 billion or less. They're going to pull $300 billion out of the economy to refill their bank accounts. Now let's put this in perspective. Last year, or last not quite 12 months, the Fed was pulling $50 billion a month out of the money, out of the monetary base through quantitative tightening, or about $600 billion a year. The Fed their Treasury, is going to do this. You can see 1, 2, 3, in about 3 months, and they may get a little more. They're going to yank a lot of money in a very, very short period of time. If this correlation between gold and the money supply holds true, it tells us that gold is going to head a lot lower because when the Fed or when the Treasury starts yanking this money, it's going to drop the M2 back down because they're going to pull this money out of the broad money supply. That's where it comes from. Pretty interesting, right? So it tells us this move gold is false. It should be retraced. Now, from an investment perspective, let me get rid of those windows. I actually did a big write-up on this on a video that it's a private subscription service, so I can't show you any more of it. And people actually thought I was really smart about that. And I said, well, So what does it tell us from an investing standpoint? Let's look at gold. Where's gold? Gold. And let's zoom back out a little bit. So what does it tell us? If this move is false, right? It tells us it should be retraced to some level. Now, why is that? If this move is false, because it's following the money supply, which is going to at some point retract, this should come back down. Now, there's two reasons, and I talked about this Wednesday, I think, when I saw that really cool interview where the guy said there's V tops in commodities because what you have is opposing positions. You have people that are long futures contracts, but you have an equal number of people that are short contracts. So as this thing goes up, you have more shorts building up too. And at some point, those people that are long look to lock in their longs. Well, how do they lock them in? They start buying shorts. That's how you lock in your long futures contracts, is you start taking the opposite position. So they'll start shorting. Well, then obviously, who's on the other end? They got to start taking longs. And you get this rapid move because everyone wants to cover their position. So it tells us there should be a rapid move down in gold. And why is that important? Because it's going to finally tell us where the big players are at. If gold goes down and blows through 1200, yeah, then there's no big players in here. If gold comes down to 1300 or 1240 or 1200 and finds and stops, that's where the big players have got it. That's what we don't know. That's what we need to know. And the reason I say that is because if you look at moves right in here, this you've got a move from 21 down to 18. So that's more, over a 10% drop in 1, 2, 3, 4, 5, 6 trading days. It's a lot of risk that we don't want to take. We want to take this where we know the probabilities are favorable of going up. So we'll see that with the gold miners when they retrace. The silver miners, on the other hand, never played in the rally. They're playing this appropriately, so they should retrace too. And then we should also see that in the junior miners that are way out of bounds up here, and they should retrace down. That should tell us where the big money is at. Maybe it comes all the way down to here. I don't know. Maybe it stops somewhere in here. That tells us where the big players are at because they'll put a stop to it, and that's where we want to be. All right, so that's on that. Now, we've got about 4 minutes left. Got a lot to cover yet, so let's get on with the show. The S&P 500 closed below its Thursday open. That's not a bullish signal at all, so we'll see what the market. You see it solidly closed down all the way into market close. That is a bearish signal, so we ought to see the market open down on Monday. We'll see. Treasury yields have been flat-ish, but after coming up into the supply zone, they got rejected there, and they were lower on the week. We see long Treasury yields lower on the week after confirming their 50-day moving average. So we're seeing yields getting very, very close to breaking down. But I think oil could be the catalyst. This is another one of those charts that I was looking at that I'm like, oh, wow, I had no idea. So here we go. Now, when you see this wedge, where you have this triangle, this kind of reverse megaphone. So we looked at the megaphone going the other way. So what you do is you draw a line from the peak to peak, or trough to trough, and you get a symmetrical triangle. When prices break either above the top line or below the bottom line, it means the prices are going to move quickly up or down depending on which way it goes. So we can extend this tan line out, and it's roughly telling us somewhere around 53 a barrel, maybe by 54 into next week. We'll see that when crude oil breaks this, it's telling us it should crash way down. Now, I don't want to cause alarm when I say this. Some people will be very happy about what I'm about to say. Some people won't. The way you measure the move down is you take the high, so up here around, we'll just say 75 to use some round numbers, and then you would draw straight down to where this orange line comes down here. Let's just not do this. Let's say 75 to 40. Let's just say 75 to 45. Let's make it real simple and say there's a $30 price difference. What you would then do, well, you know what? Let's make it 30. Let's make it 32, or 33, because we'll get some round numbers here. So then you would take the price that it crosses the line at, so 53 minus 33 tells you from a measurement pattern that crude oil should go down to somewhere in the $20-some per barrel. Again, some of you are going, outstanding, because, yeah, that's where you want to be buying. Others are going to be like, oh, my God, I hope that's not true. Again, I'm just saying that's how you measure these. I'm not saying that's how it will happen or why it will happen or if it will happen, but I can tell you this. If it breaks below this line here, there will be selling. That I can assure you. Now we see this even in the oil ETF, symbol USO. And you can see it's headed down, and it looks like it's going to break here, maybe next week, week after, but not much longer. This thing's going to break, and then that's going to send oil prices lower. That's where we want to buy. And what's interesting is you look at oil and gas producing stocks, and they're coming back down to their 1, 2, 3 quadruple bottom going back to 2016. Okay, check this out. So we'll zoom into the 1-year chart. There's not a lot of volume here. There's been some volume, but there's not this huge cascading volume. In fact, today there's a little bit of buying on the fact that Iran seized an oil tanker. Look, you know what? If one oil tanker changes the whole supply dynamic of the world's crude oil, we have problems. So let's zoom back out, because on here we've got two important things. One, we've got sentiment, which is showing bearish sentiment, which is good. We want to see sentiment falling because prices follow sentiment, not always, but mostly. And this silverish line is 5-day average 5-day volume. Well, we got a little bit of spike in volume, but not much. So big moves down come with big spikes in 5-day volume, meaning when this thing breaks support here, as I suspect it will, these prices are going to plunge. Volume will start to pick up. There'll be an awesome bottom, and if we use these signals, we should be able to snag it. And this should come fairly quick. How low this could go? Very, very low. I've been saying that I think the bond market is going to break. I think it could be the crude oil market that's going to break. Let's take a look at bonds. We see bonds. Here's a long bond. This is a position we're in. It's holding the 50-day moving average, looking like it's going to break out. So you could get a tandem move in bonds going higher and crude oil going lower. That would be extremely interesting because the whole stock market would start to unwind. Looking at ag commodities, we'll see they're consolidating. If we draw a little box around these, we see here's a bottom, here's the top. We saw a nice big rally today, pulling above the 50 and 100-day moving averages. So again, we want to see this shoot back up here. It's possible in a couple weeks after the heat hits the Midwest and destroys a lot of crops, maybe the world will wake up to realize that these are way undervalued, and that will get prices to get going there. All right, so we are a couple of minutes over, but I wanted to tell you the target on crude oil is around $53 to $54 a barrel. Watch for that to break. How low it goes, I don't know. But we'll be in on that deal like crazy, because if that thing cascades down, it's going to come back, because the Fed will then ease. Financial conditions will seize up real hard. The Fed will ease. There'll be some sort of rebound. And now that we can use that 5-day volume tracking and a big wash down, we'll be looking for that. We'll be looking for gold to pull back, because the view is there's no CPI. I know there's inflation, but the CPI is saying it's decelerating and interest rates aren't moving. So it tells us there should be a big pullback in both. Should be some big buying opportunities. I'm looking forward to grabbing whichever one comes first. I'm Steve Van Metre. We'll see you Monday. Hope you have a great weekend. Bye now.